HeyMax, the complete strategic analysis. An independent investigation into a Singapore startup that built its own money. Research current as of the 28th of July, 2026. Before we start, a word about what this is. This is a full strategic teardown of a company called HeyMax. Everything in it comes from public sources. The company didn't cooperate with this, didn't review it, and doesn't know it exists, which means two things. First, nothing here is confidential, and nothing here is flattering by obligation. And second, where I've had to estimate something, I'll tell you I'm estimating, and I'll show you how I got there. If I don't know something, I'll say I don't know. There's a lot in this business that isn't public, and pretending otherwise would waste your time. One more thing before we begin. Money. HeyMax raises capital in US dollars and prices its products in Singapore dollars, so I'll switch between the two, and I'll tell you which one I'm using. When I talk about what a mile is worth, I mean Singapore cents, unless I say otherwise. The working exchange rate is $1 to $1.31 Singapore. Right, let's begin. Chapter 1. What HeyMax actually is. Let me give you the whole company in one breath, and then we'll slow down. HeyMax is a Singapore company, registered as Max Now Private Limited, founded in 2023 by 4 engineers who had just been laid off from Meta's Singapore office. It issues its own currency. That's the key thing, not points that you spend in a catalog. An actual currency, called Max Miles, that you earn by shopping through HeyMax at more than 800 merchants, and that you can then take out of the ecosystem entirely, one for one, into about 20 real airline and hotel loyalty programs. Cathay Pacific, Qatar Airways, Air France KLM, Japan Airlines, Accor Hotels. Or if you don't want to deal with airline award charts at all, you can just book any flight, on any airline, anywhere in the world, upload the receipt, and HeyMax will pay you back in cash at 1.8 Singapore cents per mile, straight into your bank account. They call that fly anywhere, and we'll come back to it, because it turns out to be the single most important product decision this company has made. And then on top of that consumer business, HeyMax sells the same currency and the same infrastructure to other businesses. Banks, fintechs, retailers, employers. Their own line for this is, and I quote, the Stripe for miles, one API, 30+ airlines and hotels. So a consumer app, a private currency, and a business-to-business platform, 3 things at once. Now where does that leave them today, in the middle of 2026? They've raised $13.6 million, 2.6 million in seed funding in July 2024, led by January Capital. Then 11 million in a Series A in January 2026, led by Peak XV Partners, who you might still think of as Sequoia India and Southeast Asia. On my estimate, that Series A valued the company somewhere between $50 and $61 million. They have 150,000 registered users. Their last disclosed monthly active number was 44,500, and that was from the first quarter of 2025, which is a detail we're going to come back to, because 16 months of silence on your most important engagement metric is itself a piece of information. Revenue is around $6 million on an annualized basis, growing 5 times year on year. That's their number, disclosed in May 2025. My own estimate for the full year 2026 is somewhere between 12 and 16 million. They issue more than 500 million Max Miles every year. They have around 30 people, up from 10 a year ago. They're live in Singapore and Hong Kong, and they've said they'll be in Japan, Taiwan, and Australia by the end of this year. That's the company. Now here's what I actually think about it. Chapter 2. The trick at the center of the business. Every business has one idea at its core, and if you can't say it in a sentence, you probably haven't found it yet. So here's HeyMax's in a sentence. Merchants pay HeyMax in cash. HeyMax pays consumers in miles, and a mile is worth more to the consumer than it costs HeyMax to produce. That gap is the entire business. Let me make that concrete, because it's the difference between HeyMax and every cashback app you've ever used. When ShopBack gives you $1 of cashback, that dollar costs ShopBack exactly $1. There's no spread. The only way they make money is if the merchant paid them more than $1 in the first place. When HeyMax gives you a mile, it's different. You look at that mile and you think about business class to Tokyo. In your head it's worth 2, maybe 3 cents. But on my reconstruction, that mile costs HeyMax about 1.16 Singapore cents to issue, and I'll walk you through exactly how I got to that number in a moment. And crucially, about a quarter of those miles will never be redeemed at all. Someone signs up, earns a few hundred miles, forgets about it, and the balance sits there forever. So HeyMax is paying for growth in money that it prints itself, at a discount to the value the customer places on it. That's not a gimmick. That's the same trick airlines have been running for 40 years, and it's why frequent flyer programs are often worth more than the airlines that own them. That's the good news. Now let me give you the bad news, because it's the same fact viewed from the other side. That 1.16 cents is not free. It's a real cost. It's just a deferred one. When a member finally does transfer their miles to Cathay Pacific, HeyMax has to go and buy those Asia miles from Cathay with actual money. And the longer the program runs, the more of those bills come due. Here's the number that made me sit up. As of May 2025, HeyMax's members had earned 272 million max miles, and they had redeemed 27 million. That's a redemption rate of just under 10%. 10%. In a mature loyalty program, that number is 60 to 80%. Which means 90% of the cost of HeyMax's business model hasn't arrived yet. Let me put a figure on it. My estimate is that by the middle of 2026, HeyMax has roughly 700 million max miles outstanding in customer accounts. If 75% of those eventually get redeemed at a blended cost of 1.5 cents each, that's a future obligation of about $6.2 million US. Now hold that number next to this one. HeyMax has raised $13.6 million in its entire life. The deferred cost of the miles already sitting in customer accounts is 56% of every dollar the company has ever raised. That number does not appear in any press release. It's not in the funding announcement. It's not in the metrics blog post. It isn't hidden, exactly, nobody's lying about it. It's simply never discussed. And I'll tell you now, it is the first thing a Series B investors' diligence team will build a model for. Which is why one of my strongest recommendations when we get to the strategy chapters is that HeyMax should build that model first and publish it before anyone asks. Chapter 3. The People. In late 2022, Meta cut about 11,000 jobs worldwide, and the Singapore office wasn't spared. 4 engineers from that office found themselves simultaneously unemployed: Joe Liu, Wang Qi, Jialu Zhong, and Sean Dai. Joe Liu is the chief executive. He describes his own title on his profile as co-founder, CEO, and chief max miles hoarder, which tells you something about the culture. He has a science degree from the University of Michigan. Before Meta, where he was a software engineering manager, he was at Expedia, and that matters more than it might sound, because HeyMax is fundamentally a travel distribution business wearing a loyalty coat, and Liu has seen the other side of that margin pool. He's also, by his own account, personally cycled through more than 100 credit cards. He didn't invent this idea in a moment of unemployment. He says he spent roughly 3 years working out the framework before the layoff gave him the time and the co-founders. He's an unusually good talker about his own business, and 2 of his lines are worth repeating because they're actual strategy, not just sound bites. The first, why does the consumer have to start with a loss? That is the fundamental question. That's the whole thesis. Traditional loyalty programs are designed so that what you get back is worth less than what was extracted to fund it. HeyMax is an argument that it doesn't have to be that way. The second, consumers will increasingly be universally smart and savvy because it will cost almost nothing to be smart and savvy. That's a bet on AI destroying the value of expertise. And if he's right, the money stops being in asterisk knowing which card to use and starts being in asterisk aggregating, which is exactly where HeyMax has positioned itself. Now the other three founders, Wang Qi and Jialu Zhong, keep low public profiles. Sean Dai is the most externally visible of the three, usually carrying company announcements, which suggests a commercial or partnerships role. Beyond that, I genuinely don't know, and I'm not going to invent an org chart. What I can tell you is who joined them. The early hires came out of Endowus, Aspire, Funding Societies and SingSaver. Notice what that is. That's Singapore's fintech bench, wealth management, small business banking, lending, comparison. It is not a loyalty operations bench, and that gap shows up throughout this analysis. HeyMax is fluent at business development and distribution, and it appears to have learned the actuarial side of running a loyalty program, liability modeling, breakage forecasting, hedging your cost of miles, on the job, and in public. Headcount today is about 30 people, up from 10 a year ago. There are 11 open roles as I write this, and the shape of those roles is genuinely revealing. 5 are engineering and product, all in Singapore. 5 are marketing and affiliate management, spread across Singapore, Hong Kong, Kuala Lumpur and Manila. 1 is customer support in Manila. So Kuala Lumpur and Manila are cost centers, not markets. There's no country manager in either. That's a shared services build, and it's a smart margin move. Those markets run at roughly a third to a half of Singapore cost for equivalent seniority. But look at what's not on that list. There's no risk role, no actuary, no compliance hire, no finance lead, no business development role for the B2B business that I'm about to argue is the entire future of the company. For a business that has just launched a credit-shaped product, and that carries a 9-figure liability denominated in a currency it prints itself, the absence of a risk or actuarial hire is the most striking thing in the whole org picture. And one more, they've said they'll be in Japan, Taiwan and Australia by the end of 2026. It's July. There are no roles open in any of those 3 countries. That expansion is either going to be partner-led and very asset-light, or it's going to slip. And I'm going to argue later that slipping it would be the right call, not a failure. Chapter 4, the product and the 90-day clock nobody talks about. Let's walk through what HeyMax actually does, because the surface area is bigger than any review I've read captures, and the surface area is asterisk the strategy. There are roughly 13 ways to earn a max mile. The main one is affiliate shopping. You open HeyMax, you find the merchant, you click through, and you buy as normal. The rates are set per merchant and then per category within that merchant. Let me give you a real example, taken directly from HeyMax's Klook page as it stands today. Travel insurance on Klook earns 8 max miles per dollar. Tour hotels, dining, car rentals, attractions, all 1.6. Special activities and Klook gift cards, 0.8. And some activities earn nothing at all. That's a lot of granularity, and maintaining it across 800 merchants is genuinely hard, unglamorous work. Then there's buying vouchers and gift cards inside the app, where the miles land instantly. There's card linking through a product called Card Maximizer, built with Visa, which reads the merchant category code and tells you which of your cards to use. There are direct deals with card issuers, the standout being Chocolate Finance, whose Visa debit card became, in February 2025, the first debit card in Singapore to earn miles on essentially everything, including categories that credit cards normally exclude: utilities, insurance, hospitals, school fees, government bills. You can earn on the bus and the MRT in Singapore. In Hong Kong, since December 2025, you can earn on Octopus payments, and if you know Hong Kong, you'll understand what that means. Octopus is how the city pays for things. That's like getting inside the turnstile. You can earn on restaurant reservations. You can convert points in from U Rewards Club, one of Singapore's biggest retail coalitions. And there's a referral program that has spawned an entire cottage industry of referral code websites, which is itself evidence of how fast this thing has been spreading. Now, redemption, 4 main routes. 1. Transfer 1-for-1 to about 20 airline and hotel programs, minimum 1,000 miles. 2. Fly anywhere, any flight, any airline, any cabin, anywhere. Upload the receipt. Get paid 1.8 cents per mile straight to your bank via PayNow, usually within 60 to 90 minutes. That last detail is genuinely impressive operations. 3. Gift cards at 100 miles to the dollar. That's 1 cent a mile, and it's the worst deal on the menu. 4. Book flights and hotels directly in the app at roughly 0.8 to 1 cent a mile. Also a bad deal for you, and not coincidentally, probably the best deal for HeyMax. Here's the structural insight that falls out of that list. Fly anywhere at 1.8 cents is a asterisk floor asterisk. It's unconditional and it's denominated in cash. Transfers are the asterisk ceiling at the right partner on the right award. A mile has been worth 3 cents or more. Gift cards are a drain that only uninformed users take. Which means a rational, informed user never redeems below 1.8 cents, which in turn means HeyMax's marginal cost for every engaged user it has is effectively floored at 1.8 cents. Its blended cost is only lower because some people take gift cards and because a quarter of miles are never redeemed at all. That one paragraph is the entire margin story of this company. Now, the 90-day clock. If you look carefully at any HeyMax merchant page, there's a little timeline at the bottom. Purchase today, tracked in 1 day, redeemable in 90 days. 90 days. Every mile you earn sits frozen for a quarter of a year before you can spend it. Almost nobody writes about this, and it's economically enormous. It creates a rolling 3-month float on every mile issued. It delays the moment the liability crystallizes, and it gives HeyMax a 90-day window to claw miles back if you return the item or file a chargeback. It's also, from the user's side, the single most common reason people find this product frustrating. You bought something in January. You can't spend the reward until April. And that's the honest tension in HeyMax's consumer product. The mechanics that make the economics work, click-through attribution, cookie windows, the 90-day hold, category-level rate tables, are exactly the mechanics that produce a mediocre experience for the median user. Both app stores rate it 3.7 out of 5. For a product with an evangelical community and a self-reported customer satisfaction score of 4.5, that gap tells you the passionate cohort is small and everybody else is finding friction. That's not a bug you fix with polish, that's a strategic fork. Chapter 5, HeyMax First, or How to Lend Someone Money You Printed Yourself. In July 2026, HeyMax launched what it calls the world's first Miles Upfront membership. It's called HeyMax First, and it is simultaneously the most commercially clever thing this company has built and the most likely source of its next problem. Here's how it works. You get access to a pool of miles, up to 1 million of them, that you can draw down before you've earned them. You book the flight now. You earn the miles back later through your ordinary spending. There are 4 tiers. Silver is free for life and gives you a pool of 30,000 miles. Gold costs 299 Singapore dollars a year for 100,000. Platinum is 699 for 300,000. And Reserve is $1,999 a year for a pool of 1 million miles. But the annual fee isn't the real price. When you actually draw miles from the pool, you pay an access fee. 3 cents a mile on silver, down to 2.3 cents on reserve. So if you're a gold member and you draw your full 100,000 miles, that's $2,700 in access fees on top of the $299. You pay it by bank transfer, the miles land instantly, and you repay in 10,000-mile blocks out of your future earnings. There is no deadline, none. You can stop paying your membership, go dormant for 2 years, come back, and still reclaim. And the access fee is fully refundable as you earn the miles back. Now let me strip the marketing off and tell you what this actually is. It is an uncollateralized, non-recourse, open-ended advance of a currency that the lender itself prints, priced at 2.3 to 3 cents a unit, against a floor redemption value of 1.8 cents, with no maturity date and no credit assessment. Every part of that sentence matters. Uncollateralized and non-recourse. If you never earn the miles back, HeyMax's only remedy is to keep your access fee. No collections, no credit reporting. A currency the lender prints. HeyMax's cost of granting you 100,000 miles is not $2,700. It's about $1,550, and only when you actually redeem them. Priced above the floor, at 2.7 cents against a 1.8 cent cash out, buying miles to cash out is value destroying. This product only makes sense if you're targeting a genuinely high-value transfer. And no maturity, which is clever because it means there's never a moment where you're in default. There's no bad debt event. But it also means HeyMax can never cleanly book that access fee as revenue because the obligation to refund it never goes away. So how does HeyMax make money on this? And here's the part I think is genuinely brilliant. It doesn't primarily make money on the fee. It makes money because a member who has drawn 100,000 miles now has to route roughly $50,000 to $70,000 of spending through HeyMax to earn them back and get their fee refunded. The access fee isn't a price, it's a commitment device. HeyMax is selling gross merchandise volume commitment and calling it a membership. And on my model, even the worst-case member, someone who draws the whole pool, transfers it out, and never comes back, still leaves HeyMax cash positive. That's an unusual thing to be able to say about a credit product. Now the risks, and there are 4 real ones. First, adverse selection. The people most attracted to a $2,000 reserve tier are, by definition, sophisticated miles optimizers, which is exactly the cohort that will extract maximum value per mile and is least likely to route their grocery shopping through an affiliate link to earn it back. The product is priced for the average and will be bought by the extreme. Second, and this is the sharpest question anyone has asked about it, it comes from the loyalty consultancy Loyalty and Reward Co. Will people work as hard repaying a debt as they will pursuing a reward they haven't got yet? Everything we know about human motivation says no. Once you've taken the trip, the engine that was going to fund the repayment has already fired. Third, and this one genuinely bothers me, HeyMax devalues its own currency while members hold negative balances denominated in it. In June 2026, a member could have drawn 100,000 miles at 2.7 cents to transfer into Accor hotels at 1-to-1. On the 1st of July, HeyMax cut that Accor rate by 33%. Their reclaim obligation did not go down. That's a completely one-sided, unhedged exposure sitting on the customer. It hasn't blown up. It could. And fourth, regulation. Pay a fee, get value now, repay later. That shape is close enough to buy now, pay later that a regulator who wanted to look would find something to look at. It survives today because there's no interest, no credit check, and no enforceable repayment. Singapore's BNPL regime is currently a voluntary code of conduct rather than a licensing regime. If that hardens, HeyMax First is squarely in scope. One last observation, and it's a tell. A month before global launch, in June 2026, HeyMax added a free silver tier and made reclaim eligibility indefinite. Both of those are conversion rescue moves. I read that as paid tier signups coming in below plan. The free tier is strategically right anyway. It turns the product from a wall into a funnel, but the timing is informative. Chapter 6: Following the Money. HeyMax has never published a revenue breakdown, so what follows is my model. I'll show you the working. There are 8 ways this company makes money, and I want to walk through them because one of them is almost completely undiscussed, and it might be the most interesting. Number 1, and the biggest, affiliate commissions. Merchants pay HeyMax a cut of tracked sales. Industry median across the big affiliate networks is about 8.4%, but travel runs lower, marketplaces run lower, and the networks take a 20 to 30% override off the top. I model HeyMax's realized blended rate at 4.6% of routed spending. And here's a nice validation of that. HeyMax disclosed $200 million of cumulative transaction volume in May 2025 and $6 million of annualized revenue. If most of that volume happened in the trailing year, which it did, because they said volume grew 15 times, then 6 divided by roughly 130 is 4.6%. My model reproduces their disclosed numbers from the bottom up. That's about as good a cross-check as you get from outside a company. Number 2, business-to-business miles issuance. A bank or a fintech or a retailer buys max miles wholesale to give to its own customers. SingSaver does this. Tenity, who are also an investor, does this for its own staff. And this is where the economics get genuinely different, so stay with me for one paragraph. In the affiliate business, the merchant sets the commission and HeyMax takes what it's given. HeyMax is a price asterisk taker. In the B2B business, HeyMax names the price of a mile. The customer's alternative is to go and negotiate with 30 airlines themselves. HeyMax is a price setter asterisk. That distinction is the single most important economic fact in this entire analysis, and I'll come back to it when we talk about strategy. Number 3, and this is the one nobody talks about, credit card lead generation. Every single merchant page on HeyMax renders a best card to use module covering 17 different card issuers: American Express, Citi, DBS, HSBC, OCBC, Standard Chartered, UOB, and 11 others. In Singapore, a funded credit card application referral is worth somewhere between $100 and $350. If HeyMax drives even 500 successful applications a month at an average of $180, that's over $1 million Singapore dollars a year at essentially 100% gross margin. Which puts HeyMax in the same revenue pool as SingSaver and MoneySmart, while SingSaver is simultaneously one of its B2B customers. That's an awkward and rather interesting position, and HeyMax undersells it dramatically in its own storytelling. The other 5 streams: the spread on redemptions, HeyMax First fees, campaign and media fees, corporate employee benefits, and latent, unmonetized, and a privacy minefield, the data. Put it together and here's my estimated mix for 2026 on a $14 million revenue base. Affiliate, 58%, B2B issuance, 19%, card referrals, 8%, redemption spread, 5%, HeyMax First, 4%, campaign fees, 4%, everything else, 2%. And now I can state the structural problem with this company in one sentence. 58% of the revenue comes from the least defensible, most price-taking, most cyclically exposed stream in the business. And the 2 streams where HeyMax actually has pricing power, B2B issuance and card referrals, are 27% combined. Getting that combined number above 50% is, in my assessment, more important than user growth, more important than market expansion, and more important than anything on the product roadmap. Now let me show you the profit and loss, because there's a wrinkle in it that I think is the most valuable thing in this whole analysis. For 2026, I model $14 million of revenue. The cost of rewards, the accrued cost of every mile issued this year, comes to $6.3 million. That's 45% of revenue, and it's by far the largest line. Add fulfillment and partner fees, and you get to a gross profit of about $7.2 million, which is 51%. Then operating costs. People $3.9 million, 30 people going to 45. Marketing $1.4, technology $0.6, general and administrative $1.3, market expansion $1.2, total operating expenses $8.4 million. Which gives you EBITDA of *(-1.2 million. But and here's the wrinkle, that's on an accrual basis, where you book the cost of a mile when you issue it. If instead you book the cost when the mile is actually redeemed, the cash view, then this year's reward cost is only about $2.5 million, because only around 30% of miles get redeemed in year. And on that basis, EBITDA is *(2.6 million. Same company, same year, same facts. One version says HeyMax is comfortably profitable, the other says it's losing money and building an obligation. The difference is $3.8 million, 27% of revenue. Now which one is right? Accounting standards are unambiguous here. Under IFRS 15, a loyalty point is what's called a material right granted to the customer. You have to allocate consideration to it and defer that until redemption or expiry. It's why every airline in the world reports a line called loyalty program liability in its accounts. Which means the moment HeyMax gets audited for a Series B, the accrual view is the one that appears. A founder narrative built on the cash view is going to meet a diligence process built on the accrual view. That's not a catastrophe. Every loyalty business lives with this. It's only a catastrophe if it's a surprise. Chapter 7. Who they're actually fighting. HeyMax doesn't have one set of competitors. It has 7, and it competes with each on a different axis. Let me take you through the ones that matter. Start with Shopback, because it's the one everybody thinks of first. Shopback is a Singapore company founded in 2014, 60 million users, 13 markets, $350 million raised from East Ventures, Temasek, and Credit Saison, valued at $1.4 billion as of February 2026, revenue of 133 million Singapore dollars in their 2024 financial year. And notably, they became adjusted EBITDA profitable for 3 consecutive quarters in 2025, after cutting 24% of their staff. So Shopback is 16 times HeyMax's revenue and 400 times its users. But it took a decade and $350 million and then a quarter of the workforce to get there. That is a very loud cautionary tale about the margin structure of the affiliate model at scale, and it's a strong argument that HeyMax should not simply try to become a bigger Shopback. Where does HeyMax genuinely beat them? The currency. Cashback is a rebate, miles are aspirational. $1 of cashback costs Shopback exactly $1. A mile costs HeyMax 1.16 cents and is valued by the customer at anywhere from 1.8 to 3 cents. That is HeyMax's fundamental economic advantage over Shopback, and it's real. Where does Shopback beat them? Everything else. Merchants, markets, capital, brand, data, and the ability to simply outbid HeyMax for placement. They coexist today because Singaporean shoppers treat them as complements. There are blog posts titled literally, "Why I Check Both Before Every Purchase." But that coexistence holds only as long as Shopback chooses not to launch a transferable travel currency. It could. It has the money and the merchants. The only thing it lacks is airline transfer partnerships, and it could buy those from a vendor in a quarter. Which brings me to the second competitor, and this is the awkward one, Ascender. Ascender is a Singapore company founded 2013, that sells loyalty infrastructure to banks, points transfer networks, redemption, program management. Very established, very embedded with financial institutions. Ascender also powers most of HeyMax's points transfers. So Ascender is simultaneously HeyMax's supplier, its cost of goods sold, a party with full visibility into its transfer volumes and partner mix, and its direct competitor for exactly the bank customers HeyMax needs to win. Every time HeyMax pitches a bank, that bank's alternative is often its own vendor's product, sold by a company with 10 more years of relationships. Ascender's own revenue declined about 6% in 2024, which makes it more likely, not less, to defend its accounts aggressively. The strategic conclusion here is completely unambiguous, and it's one of my central recommendations. HeyMax has to contract airlines and hotels directly and reduce Ascender to a fallback for the long tail. Every point of margin recovered there drops straight to gross profit. And notice the 2026 editions of Flying Blue, Japan Airlines, Asia Miles, EVA Air, Philippine Airlines and Radisson all look exactly like that migration already happening. Third, Chris Plus, Singapore Airlines lifestyle app. This is the incumbent HeyMax was built against, and right now it's making HeyMax's argument for it. In July 2025, Chris Plus cut earn rates at more than 250 merchants. It's closed loop, you can only get KrisFlyer miles. HeyMax's open loop, multi-airline proposition is straightforwardly better for anyone who isn't a Singapore Airlines loyalist. The caveat, Singapore Airlines owns the redemption. If SIA ever restricted third-party transfers into KrisFlyer or shut off the award availability data that HeyMax's new award companion tool scans, that would hurt badly. It's a genuine tail risk. Fourth, and this is the one I'd worry about most if I ran HeyMax. In January 2026, Agoda and MasterCard announced a partnership that embeds Agoda's travel inventory directly into MasterCard's global redemption suite, aimed at banks across Asia-Pacific. That is HeyMax's B2B pitch, delivered by two companies with infinitely more distribution. HeyMax's answer to that has to be sharp, and it has to be loud. A Max Mile is a * transferable currency the consumer owns *. MasterCard and Agoda are offering banks a redemption * catalog. Those are categorically different propositions, and the difference is the whole value of HeyMax. But that difference has to be articulated relentlessly, because from 10,000 feet, the two things look the same. And finally, let me tell you about the company that proves what this category can be worth. Built Rewards in New York. You earn transferable points on your rent *. They've raised nearly $1 billion from General Catalyst, MasterCard and Wells Fargo, and their last round valued them at $10.75 billion. Built didn't win by aggregating lots of small discretionary purchases. It won by owning one enormous, recurring, previously unrewarded category of spending. That's a lesson HeyMax should take very seriously, and I'll come back to it. One last point on competition, and it's the most important one. There's a concept in strategy called counterpositioning, where the incumbents can't copy you, not because they're incapable, but because copying you would destroy something they already have. Singapore Airlines cannot make Chris Plus open loop, because letting members convert KrisFlyer miles into Cathay Pacific miles would blow up its own loyalty economics. DBS cannot make its points freely transferable to 20 programs without giving up the lock-in that justifies the program. Ascender cannot build a consumer brand without competing with the banks that pay it. Agoda cannot be airline neutral because it has its own inventory to fill. Every serious incumbent has a reason not to do what HeyMax does. That's the most durable thing about this business, and it's worth more than any feature on the roadmap. Chapter 8: What could go wrong? I want to spend some time here, because in 2026, this company did three things that most observers filed as minor housekeeping, and which I think are actually the story. First, in May, HeyMax announced it was killing a program called Cash for Miles, and with it, removing 17 transfer partners: Air Canada, Alaska, American Airlines, Avianca, British Airways, Emirates, Etihad, Qantas, Thai, Turkish, United, Virgin Australia, and on the hotel side, Hilton, Marriott, and Hyatt. The stated reason was that it had become unsustainable, and they were specific about why. Partners were charging premium rates to buy their points, American Airlines at 3.5 US cents a mile, and the fulfillment process involved issuing virtual debit cards and, for some partners, making phone calls. Second, in June, HeyMax announced it was cutting the transfer rate to Accor hotels from 1-to-1 down to 3-to-2. That's a 33% devaluation. Members had been getting roughly 2.95 cents of value per max mile through Accor. Now they get about 1.97. The Mile Lion, which is the most authoritative independent voice in this market, read it plainly. HeyMax had seen a surge in Accor redemptions at volumes it couldn't sustain, and was metering the flow by cutting the rate. They gave 8 days' notice. Third, in July, they launched HeyMax First, selling miles forward at 2.3 to 3 cents each. Now put those three together, cut the expensive redemption routes, devalue the most generous one, and start selling miles forward at 2.3 cents and up. That is not three unrelated events. That's one event. HeyMax discovered that its real cost per redeemed mile is meaningfully higher than the 1.8 cents the market had anchored on, and it is closing the gap from both directions. Which is, honestly, the correct thing to do. It's what a well-run program does. But it establishes a pattern, and the pattern is, HeyMax's promise of stable value is discretionary, and it has now exercised that discretion 3 times in 12 months. Which leads me to what I think is the single most fixable problem in this entire company. HeyMax markets max miles with the line, "Miles never expire." It's on the App Store listing, it's on the website, it's in every review. Now let me read you Clause 4 of HeyMax's own terms of use. Quote, HeyMax reserves the right to remove a user, including the full balance in a user's account, where HeyMax determines that a user has not used the services for any consecutive period of 12 months or longer. And Clause 7 reserves the right to, quote, add or change the duration taken for max miles to expire. And Clause 6, this is the important one legally, says you gain no proprietary right, the miles are not held on trust, and your entitlement is limited to contractual rights of repayment, which, incidentally, is exactly the drafting that keeps HeyMax outside Singapore's payment services Act as limited-purpose e-money. It's also what makes members unsecured creditors if anything ever goes wrong. Now, none of these clauses are unusual. Every loyalty program on Earth has equivalents, but HeyMax's entire differentiation is being the ** loyalty program, the one that doesn't devalue, doesn't expire, doesn't play games. Its stated company value is transparency, and its own words are, quote, our team and users can rely on us to deliver exactly what we promise. Having a specific, unqualified marketing claim that your own terms explicitly contradict is a reputational fuse. It's entirely self-inflicted, and it is entirely fixable in an afternoon. Either qualify the claim or amend the clause. I'd rank that as the highest return on effort action available to this company right now. Let me give you the rest of the risk register quickly, in rough order of how much I'd worry. Number 1 is the liability crystallizing faster than modeled. Every 10 percentage points that the redemption rate rises costs about $600,000 a year at current issuance. And that rate is currently sitting at an artificially low 10% because the program is young. It has nowhere to go but up. Number 2 is a trust event. Max Miles has value because people believe it will have value, and that belief is maintained by a small, well-informed, extremely vocal community that publishes an analysis of every single change. 3 devaluations in 12 months is about the outer edge of what that community will absorb. A fourth, especially one that touched the 1.8-cent fly-anywhere floor, would be qualitatively different because the floor is the credibility. Number 3 is Shopback, or anyone with capital launching a transferable miles currency. HeyMax's defense right now is essentially they haven't yet. That needs to become they can't because we have the airline contracts. Then further down, the B2B business stalling and leaving HeyMax stuck as an affiliate company with a low multiple. Airline point prices inflating with no hedge. Cookie deprecation degrading affiliate attribution. HeyMax First attracting exactly the wrong customers. Regulatory reclassification. And expansion overreach, 5 markets, 60 people, 18 months. That last one is worth pausing on. It's July 2026. They've promised Japan, Taiwan and Australia by December. There are no hires and no announced partnerships in any of them. Chapter 9. How HeyMax raises its next round. This was one of the 3 questions I was asked to answer, so let me be direct about it. My first recommendation is, don't raise in 2026. Here's the reasoning. They closed $11 million in January. On my estimate, they have about $9.5 million left. They're roughly cash flow neutral. On a pure cash basis, they have 3 years of runway. If they went out to market right now, they'd be selling a story with 3 uncomfortable facts in it. User growth decelerated from 140% to 25%. Transfer partner count went backwards from 30 plus down to about 20 against a stated target of 50. And the revenue figure, 6 million, 5 times year on year, appeared word for word in both the May 2025 metrics release and the January 2026 funding announcement. 8 months apart, identical. Now I actually think that's a stale figure being reused rather than genuinely flat revenue, because a company growing users 25% and merchants 60% in the same window is unlikely to be flat. But whichever it is, it's HeyMax's own ambiguity, and it will absolutely get probed in diligence. So raise in the 2nd or 3rd quarter of 2027. Open the process around April. Go out on audited 2026 numbers plus first half 2027 momentum, with 18 months of deliberate metric construction in between. The target, $25 to $35 million, at a post-money valuation of $140 to $200 million. Who leads it? A growth fund with either a loyalty infrastructure thesis or a travel distribution thesis. General Catalyst is the obvious name because they led built and already have conviction in this exact category. Insight or Bessemer if you want infrastructure multiples. GIC or Temasek if you want Singapore native patient capital, though note Temasek already backs Shopback, which cuts both ways. Regionally, Jungle Ventures, Vertex Growth, B Capital. And here's a recommendation I'd make strongly. Bring an airline or an airline group onto the cap table as a strategic co-investor. It converts the single largest supply-side risk in the business, the cost of and access to redemption, into an aligned relationship. And it's the strongest possible signal to every other airline in the pipeline. Now the metrics that have to be true by the 1st quarter of 2027. There are 12 in my full analysis. Let me give you the 6 that matter most. Annual recurring revenue above $20 million. B2B at 40% or more of revenue. That's the single most important one, and I'll explain why in a moment. Revenue outside Singapore above 20% to prove the expansion thesis is real and not a slide. At least one named Tier 1 bank or telco issuing max miles. They don't have one. SingSaver is a comparison site. Chocolate Finance is a fintech. Neither is a marquee logo. 35 or more redemption partners, the majority contracted directly rather than through a sender. And a published, audited miles liability model with a stated breakage assumption. That last one deserves emphasis because it's counterintuitive. Most founders would want to keep that number quiet. I think exactly the opposite. A company that walks into a diligence process with its own liability model, its own redemption curve, and a defensible breakage assumption looks like an asterisk program operator. A company that has one produced for it by an investor's accountants looks like a startup that didn't know what business it was in. Now let me talk about the narrative, because I think this is worth $80 to $120 million of valuation, and it costs nothing but discipline. What HeyMax says today is, roughly, AI-powered loyalty and travel rewards platform, 150,000 users, 800 merchants, 500 million miles, expanding across Asia-Pacific. That is a asterisk consumer app asterisk story. Consumer apps price at 4 to 6 times revenue. On $20 million, that's 80 to 120 million, below target. What they should say is something like this. We are the redemption network for Asia's loyalty economy. Every bank, every coalition, every retailer in Asia has a points program its customers don't value because the points can't buy anything anyone actually wants. We fixed that with one API. Plug in, and your points become travel on any of 50 airlines and hotels at a price we set. And we proved the demand ourselves. We built the consumer app first, deliberately, because no infrastructure company can credibly tell a bank what consumers actually want. We have 250,000 people in 2 markets who choose our currency. We know what a mile is worth to them to 1/10 of a cent, and we know exactly what it costs us to deliver because we publish it. Now the banks are coming to us. 40% of our revenue is contracted B2B and growing faster than the rest. Our consumer business isn't the business. It's the demand proof, the pricing engine, and the moat. That's an infrastructure story with a consumer flywheel attached. Infrastructure prices at 8 to 12 times revenue. On $20 million, that's 160 to 240 million. The narrative change is worth about $80 to $120 million of valuation, and it is only credible if the B2B mix and the bank logos are actually real. Which is why the strategy and the story have to move together. You can't just say it. One more thing worth knowing. On my estimated cap table, the founders hold somewhere between 48 and 56% today. After a Series B at 17 to 20% dilution, they're at 38 to 46. After a Series C, low to mid-30s. Which means the Series B is very likely the last round where founder control is genuinely comfortable. That argues for a clean Series B, then a hard push to profitability, and a Series C only from a position of strength, not a mechanical ladder of A, B, C, D. And I should say plainly, acquisition is a live and entirely respectable path here. Plausible buyers include Shopback buying the currency, a sender buying consumer demand, a bank buying the rewards layer, an OTA buying loyalty, or Built buying Asia-Pacific. At $150 to $400 million for a team that raised 13.6, that is an excellent outcome. It should be run as a legitimate parallel path, not treated as a failure. Chapter 10: How HeyMax becomes market leader. Second question, and the first thing to do is pick a category you can actually win. HeyMax cannot lead loyalty in Asia. Rakuten's there, Ascender's there, every bank is there. It cannot lead cashback in Asia. Shopback has already won that. It cannot lead travel booking. Agoda, Trip.com and Klook have won that. But there is a category it can lead, and in fact largely already does. The open-loop travel currency and redemption network for Asia-Pacific, the layer that turns anyone's points into any airline's miles. HeyMax defined that category, It has the only consumer brand in it, and as I explained earlier, every serious incumbent is structurally conflicted about entering it. Leadership means one specific thing. When any bank, coalition, retailer, or fintech in Asia-Pacific decides its points need travel redemption, HeyMax is the first call. 5 pillars to get there. Pillar 1. Own the redemption supply, don't rent it. This is first for a reason. Partner count went from 37 to about 20 in 2026, against a target of 50 plus by 2027. So that's now a 2.5 times build in 18 months from a reduced base, while simultaneously trying to lower cost per mile. Those two goals are in tension because the cheap partners are the ones already signed. The plan: direct contract the top 20 programs with multi-year terms, volume-tiered pricing, and critically, notice provisions on price changes. Get back the programs the community most missed: Marriott, Hilton, Hyatt. Push for preferential tier arrangements, not full exclusivity. Airlines resist that, but something like best available rate to any non-bank partner in Southeast Asia. Why is this pillar 1? Because it's the only action HeyMax can take that pays off 3 separate ways. It cuts cost of goods sold, it builds the only real moat available, and it removes the ascender dependency. Nothing else on the list does all 3. Pillar 2. Make B2B the business, and say so out loud. 19% of revenue today. No published API documentation, no published pricing, no security or compliance page, no Tier 1 logo, and no senior commercial leader. So hire a chief commercial officer with airline loyalty or card network experience. That is, in my view, the single most important hire in the company, and David Lee, the former president of Visa Asia Pacific, who's on the cap table, is the sourcing channel. Then publish the platform. API reference, sandbox, integration guides, pricing tiers, service levels, and a security page with a SOC 2 roadmap. Banks buy compliance before they buy product. Right now, one API is a marketing claim with no public surface, and real infrastructure companies publish documentation because that's how they get bought. Productize it into 3 clear things you can sell. Buy max miles for your customers, keep your own currency and plug in our redemption, or let us run the whole program. And land 2 lighthouse accounts by mid-2027. Price aggressively, the logo is worth more than the margin. Pillar 3. Grow through coalitions, not through signups. Here's the uncomfortable arithmetic. HeyMax has publicly targeted 1 million users by the end of 2026. They were at 150,000 in January. That requires nearly 7 times growth in 11 months, from a base that grew 25% in the preceding 8. On the current trajectory, they reach somewhere between 220 and 280,000. That target is not achievable through app downloads. It's only achievable if a large user base gets migrated in at once, which is exactly what a coalition deal does. They've already done this twice. U Rewards Club in Singapore, Octopus in Hong Kong. The template works. Now do it once per market. Line points in Taiwan. Flybys or Everyday Rewards in Australia. Flybys alone has 8.6 million members, which is 57 times HeyMax's entire user base at 0 acquisition cost. Ponta or a JCB consortium in Japan. BonusLink or Touch, Go in Malaysia. One coalition deal is worth more than a year of organic acquisition and costs a fraction as much. And a related recommendation: reset the 1 million user target publicly. Replace it with an engagement metric, monthly actives, share of wallet, miles redeemed. Missing a loudly stated public target damages Series B credibility far more than changing it does. Pillar 4. Close the share of wallet gap. This is the highest return work available anywhere in this company. Here's the number that should keep the product team awake. HeyMax's own marketing says an average Singaporean household could earn 25 to 50,000 max miles a year. The actual realized average across their registered users is about 3,300. HeyMax is capturing somewhere around 7 to 12% of the spending it could already be capturing from users it already has. Closing that gap requires no new users, no new market, no new merchant, and no new country team. How? 4 things. 1. Support MasterCard and American Express, not just Visa. Visa only is the single biggest constraint in the consumer product, and most Singaporeans carry cards from 3 or 4 issuers across networks. 2. Make card-linked earning the default instead of click-through, because click-through requires the user to remember, and card-linked requires nothing, and every mile earned without a click is a mile that doesn't generate a "Where are my miles" support ticket. 3. And this is the built lesson, own one enormous recurring category: insurance premiums, utilities, school fees, healthcare, rent. The chocolate finance deal already covered exactly these categories, and it was the most strategically interesting thing in that partnership, and it was treated as a footnote. 4. Aggressive defaults, extension auto-activation, one-tap re-earn on repeat merchants, notifications triggered by card signals. Target get miles per active user from 3,300 to 8,000 by the end of 2027. At constant users, that's 2.4 times the revenue. Pillar 5. Defend the currency's credibility as a first-class corporate asset. Publish a max miles value charter. Commit to a minimum 60-day notice on any devaluation. Commit to maintaining the Fly Anywhere floor. Commit to honoring in-flight HeyMax First drawdowns at the rate that applied when they were drawn. Fix the expiry contradiction. Publish the liability and the breakage assumption. A program that shows it's working gets trusted, one that doesn't get suspected. Now, one final strategic call, and it's the one I feel most strongly about. HeyMax has announced Japan, Taiwan, and Australia by the end of this year. My recommendation is, do not launch in Japan as a consumer brand, not this year, not next year. Rakuten Points has 59% penetration among Japanese consumers. D-Point has 39%. PayPay Points has 38%. Those aren't loyalty programs, they're ecosystems with telecoms, banks, and payment networks attached. A foreign open-loop currency walking in as a consumer brand has no wedge. And here's the thing, every single one of those programs needs better travel redemption, which is precisely what HeyMax sells. Japan is a B2B market for HeyMax, not a consumer one. Adding Japan Airlines as a transfer partner in July was exactly the right first move. And that generalizes into my headline recommendation on expansion: slow the consumer expansion, accelerate the B2B expansion. B2B market entry needs a contract and an integration. It doesn't need a marketing team, a support hub, and a brand campaign. It's faster, cheaper, higher margin, more defensible, and it's available in all 5 announced markets right now. Chapter 11: How HeyMax becomes profitable. Third question, and the short answer is yes, and sooner than most consumer fintechs, but not on the current configuration. Let me show you where the money actually goes, because once you see it, the strategy becomes obvious. Of every $100 of revenue in 2026, $45 goes on the cost of rewards, $28 goes on people, $10 on marketing, $9 on general and administrative, $9 on expansion, $4 on technology. 2 lines dominate: rewards at 45% and people at 28%. Everything else is rounding. So profitability is a 2-variable problem. Make each mile cheaper or worth more, and grow revenue faster than headcount. There are 5 levers. Let me rank them by impact. Lever 1. Shift the revenue mix to B2B, worth 8 to 12 points of gross margin. I said earlier that in affiliate, HeyMax is a price taker, and in B2B, HeyMax is a price setter. moving the mix from 19% B2B to 45% lifts blended gross margin from about 51% to around 60%. And there's a second-order benefit that matters just as much. B2B revenue is cash upfront against a deferred cost, which fixes working capital in exactly the place the affiliate model is weakest. Lever 2, reduce the true cost of a mile, worth 6 to 9 points of gross margin. Direct airline contracts with volume tiers instead of going through a sender. That's 15 to 25 hundredths of a cent per redeemed mile, steering redemption toward cheaper channels through interface design and bonus timing, another 5 to 10 hundredths. Retiring or repricing the most expensive routes, which is exactly what they did with Cash for Miles and Accor, another 5 hundredths, and using transfer bonuses surgically as liability management instruments rather than as broad marketing. Add it up and you go from 1.5 cents to about 1.25. That's a 19% reduction in cost of goods sold, worth roughly $1.2 million a year of pure gross profit from procurement discipline alone. Lever 3, close the share of wallet gap, and this is the biggest one in the entire model. Getting miles per active user from 3,300 to 8,000 at constant contribution margin is a 2.4 times revenue increase, with no new users and no new markets. On my sensitivity analysis, this single variable is worth nearly $10 million of EBITDA by 2028. It's more than double the next largest lever. Lever 4, monetize the surfaces that are currently free, worth $2 to $4 million of high-margin revenue. Card referrals, properly optimized, $1 to $3 million at 95% margin. A formal media rate card for campaign placements, 80% margin. A premium consumer tier, remember, Kudos in the US charges $72 a year for less functionality than Card Maximizer Plus Award Companion, and HeyMax gives it away. And HeyMax First, which at a 2% attach rate on 1 million users at an average of $800 would be $12 million on its own. Lever 5, grow revenue faster than headcount. They're at about $467,000 of revenue per employee, which is already strong. The stated plan to double Singapore headcount by 2027 should be resisted in favor of weighting hires to Manila and Kuala Lumpur, a third to a half the cost, and growing volume through partners rather than payroll. A coalition deal adds revenue with almost no headcount. A market launch adds an entire country team. Now let me give you the 3 scenarios. Base case ***, which is where I'd put about 55% of my probability. Revenue of $14 million this year, 26 next year, 42 in 2028, 62 in 2029. B2B rises from 19% to 50%. Gross margin climbs from 51 to 63%. EBITDA breakeven arrives in the second half of 2027 at around $24 million of revenue and about 62 people. 13% margins in 2028, 21% in 2029. Aggressive case ***, about 20% probability. 2 Tier 1 bank contracts land in 2027, B2B hits 45%, direct airline contracts cut costs faster, HeyMax First overperforms. Revenue of $30 million next year, 55 the year after, 88 in 2029. EBITDA positive from the fourth quarter of 2027. That supports a Series C at 550 to 800 million. Conservative case ***, about 25%. B2B stalls at a quarter of revenue. Redemption rises to 85%, pushing the cost per mile up. Shopback launches a miles product. Expansion burns capital without producing revenue. Revenue of $20 million next year, 28, then 36. Gross margins stuck at 48. EBITDA negative through 2029, needing another $20 million, priced as a consumer app at 110 to 170 million. In that world, selling the company for 150 to 250 million is the rational outcome, and to be clear, still a good one. Let me leave you with the two numbers that actually decide which world you end up in. Miles per active user and ultimate redemption rate. The first is a growth metric HeyMax controls through product design. The second is a cost metric it can manage but not control. Every strategic decision this company makes should be evaluated against its effect on those two numbers. If a proposed feature doesn't move either one, it probably isn't worth building. Chapter 12, The Verdict. Let me close by telling you what I actually think, and then by telling you what would change my mind. Because an analysis that can't be falsified isn't analysis, it's advocacy. HeyMax has done something difficult and genuinely rare. It created a private currency that people actually want in under 3 years, on $13 million, in one city-state of 6 million people. And fly anywhere, that ability to book any flight on any airline and get paid back in cash at a published rate, gave that currency a floor. That is the hardest and most valuable thing a currency issuer can do, and almost no private loyalty currency in the world has managed it. The coalition deals gave it liquidity. The community gave it credibility. Those are real achievements, and they're not easy to copy. But the company is now at the point that every loyalty program reaches, usually much less publicly, the moment when the true cost of the currency becomes visible. Everything that happened in 2026, the killed program, the 17 removed partners, the 33% Accord devaluation, and the launch of a product that sells miles forward at 2.3 cents, is the same event, seen from 4 different angles. HeyMax is finding out what a max mile costs and repricing accordingly. Handled well, that's the transition from a startup that gives things away into a business that knows its margins. Handled badly, it's the slow erosion of exactly the trust that made the currency valuable in the first place. And once a loyalty currency's credibility goes, it does not come back. So 3 things decide which of those happens. 1. Does the revenue mix move to B2B? That's not a monetization preference. It's the difference between being a price taker and a price setter, between a 4 times multiple and a 10 times multiple, between $80 million and $200 million at the next round. 2. Does share of wallet close? They already have the users. They're capturing about 1/10 of what those users could give them. It is the largest, cheapest, lowest risk growth available to this company, and it requires nothing new. 3. Does the currency stay credible, publish the liability, fix the expiry contradiction, commit to a notice period? These cost almost nothing and protect everything. Here's my overall grade: B, maybe B+. Product A-, market opportunity A, execution A-. 5 major products in 26 months and a whole market entered and launched in 4 is genuinely impressive. Team B+, business model B-. Competitive moat C+, and that's the honest one, because right now their protection is speed and focus, not structure. Speed is a wonderful position for a Series A company, and an untenable one for a Series C company. My assessment: HeyMax is more likely than not to succeed, and considerably more likely to be acquired somewhere between $150 and $400 million than to become an independent billion-dollar company. Both of those are excellent outcomes for a team that raised $13.6 million. The independent path requires B2B to become the majority of revenue by 2029, and that requires a commercial capability they haven't hired yet. Now, what would change my mind? I'd get materially more positive if monthly active users are disclosed above 80,000, if a Tier 1 bank is announced as issuing max miles, if 2026 revenue lands above 18 million, meaning my growth assumptions were too cautious, if direct airline contracts replace a sender on the top 5 partners, if a second coalition deal on used terms gets signed outside Singapore, or if they publish their miles liability voluntarily. I'd get materially more negative if monthly actives come in below 50,000, which would mean active users were essentially flat through 2025 and 26. If the Fly Anywhere floor of 1.8 cents ever gets cut, and I want to be clear, that would be qualitatively different from the Accor devaluation because the floor is the credibility. If Shopback or Grab or a bank launches a transferable travel currency in Singapore, if there's a fourth devaluation inside 12 months, if HeyMax First drawdowns grow much faster than reclaims, or if they launch consumer brands in Japan, Taiwan, and Australia simultaneously. Let me finish with the thing I keep coming back to. The most valuable asset this company owns isn't the currency, or the merchants, or the technology. It's that 4 engineers who lost their jobs in 2022 built, in 3 years, something that a $50 billion airline, a $1 billion cashback platform, and every bank in Singapore looked at, and concluded they couldn't build without cannibalizing themselves. That's a real position. It's worth defending properly. And if I had to compress the whole of this analysis into a single sentence, it would be this. HeyMax built a currency people want, and is now discovering what it costs. Whether it becomes the loyalty infrastructure of Asia or a very well-executed affiliate business with a clever rewards wrapper depends almost entirely on whether it moves the majority of its revenue to the side of the business where it, rather than the market, sets the price. That's the analysis. Thank you for listening.